Hi everyone, this is Michael Kramer of Ma Capital. Today is Tuesday, December 10th, and it's around 4:45 New York time. So tomorrow we're going to be getting US CPI. That comes at 8:30 a.m. Eastern. Right now, analysts are looking for a 0.3% month-over-month increase, which would be hotter than last month's reading, and core is expected to come in at the same at 0.3% in line with last month. CPI year over year expected to rise at 2.7% from last month's 2.6%, while core is expected to remain unchanged at 3.3%. Thursday, we're going to get a PPI report, which is important because that will be factored into the PCE report that analysts like to try to figure out ahead of that number later this month. And then, of course, initial jobless claims. We're going to be continuing to watch these along with continuing claims, which came down last week. And then on Friday, we're going to wrap it up with import-export prices, which, again, will be part of the PCE component, although they don't carry as much weight as PPI and CPI. And with the CPI report coming up, we've seen interest rates begin to rebound a little bit here in the U.S., which is, of course, helping to lift the U.S. dollar index back above its 10-day exponential moving average. At least the DXY for now has survived a pretty important level of support around this 106 area, and that's exactly the opposite of what's been happening with the euro. The euro basically got up to around 106 or so on the, which has also been a major level of resistance and support going back now for several months. And you can see we got up to that level just on the 6th. We failed at that level and now have started to move back down again. And now the euro is trading back below the 10-day exponential moving average. I mean, clearly the big levels here for the euro come at 104.5. If you break 104.5, we're talking about revisiting the November 22nd lows. If we are able to hold this area around 105.5 to 106, clearly sets up a chance to break out again to the upside and potentially push towards 108. However, when you look, you can clearly see that momentum is still looking fairly bearish on the RSI for the euro. And if, depending on what that CPI report and PPI report come in tomorrow and Thursday, it could really alter where this is going to go. Clearly a hot number here in the U.S., a number that suggests inflation has reaccelerated some degree from what we were seeing over the summer months, certainly would be enough to start pushing the euro lower again versus the dollar. And really, you're seeing the same thing versus the British pound. Although the British pound looks a little bit better than the euro, at least it's holding above the 10-day exponential moving average. At least the RSI is showing signs of potentially changing trend. So the big level here to watch on the pound is the 128 area. If we can break above 128, that clearly opens a path back towards 130. A failure at 128, though, leads back to a decline back towards 126. It's also a very similar look for the yen. Basically, the yen was able to bounce off of support at 149.30, and now it's been rising, which indicates the yen has been weakening versus the dollar, and it's weakened to about 152 at this point, clearly back above the 10-day exponential moving average. We are seeing the RSI begin to turn lower again. The question really becomes, are we going to make a higher high or not, or are we going to continue to really be in a downtrend? Right now, the talks and rumors of a BOJ rate hike have subsided some, and that's why you're starting to see the yen weakening again. As we get closer to that rate decision, we may see the yen begin to strengthen again and move back down. Clearly, a breach of 149 sets up extremely much stronger levels for the yen going forward. And gold has also been starting to percolate again a little bit. The 2,700 area, clearly a big level of resistance. The big thing for gold is going to be about what the dollar and mostly what real rates do. Higher real rates, stronger dollar probably means that gold doesn't get beyond 2,700. So if we start seeing things like the DXY moving higher tomorrow, the TIP ETF TIP, which is a which basically measures inflation protected securities, and the measures gives you a directional guide in terms of which way real rates are going, because when the TIP ETF is going down, real rates are rising, and when the TIP ETF is going up, real rates are falling. So if you were to see a scenario where TIP ETF going lower tomorrow, DXY going higher, that would probably be a negative signal for gold, and you'd probably want to watch that. Obviously, the inability to get above 2,700 on gold clearly would be bearish, would set up probably a retest of 2,500. Otherwise, you're talking about it revisiting the high seen in late October. Oil is continuing to coil up here around between the $66 and $69 level. Clearly oil hasn't been able to break out. Clearly oil is really just consolidating. It looks like there's going to be a big move coming. I guess the only question is which way is this big move going to come? I mean, clearly when you look at the setup, the trend has been bearish for some time now, and the $66 level has been an important level of support for a very long time as well. So my view has generally been that oil is going to break lower, only because my belief is that the dollar is going to continue to strengthen. If you believe the dollar is going to continue to strengthen too, and oil does break below 66, you're talking about a potential move back down to around 56 or 57, which would be about a $10 decline. And obviously, it could get much lower than that if you start seeing it breaking that area of support. Although, again, we still haven't seen that quite happen yet, but we are waiting to see how that develops. When we look over to European indices, we've seen the DAX index go on to make new highs again. Again, the DAX just doesn't seem to play by fundamental rules at all. So really, when you're trading this, you really doesn't seem like you should be incorporating those views into your analysis at all these days. And it seems to be more a function of a global market liquidity. Clearly the DAX has gotten to an overbought level. We talked about this the last time. It's even more overbought than it was the last time we spoke. It has started to come down a little bit. And again, this seems like a very valid area to see some form of consolidation, especially with the RSI on the DAX over 70 and it hitting up above against its upper Bollinger Band. What this would imply at the minimum is that we should see at least some sideways consolidation in the DAX, even if the next move up even if the next major move is going to be up. This would kind of suggest to me that we should see some sort of pullback in the DAX, or at least a sideways consolidation, perhaps where we see the DAX return somewhere to that 20-day moving average area. The FTSE, when we move over to the FTSE's back to its old tricks. Got up to 8350. That's basically where it stopped. Now we're heading lower again. Support would probably be around the 20-day moving average, right now at 8225. If we can get above 8350, which has been a real challenge, you have room to run to around 8450 or so. But again, even the RSI has been failing around 65, which also kind of suggests that you probably don't have the momentum needed to get above that 8350 level. And the next region could be at 8180 to 8230, which would be the 20-day. When we swing over to the NASDAQ, at least, we can see that the NASDAQ has been essentially just trending higher along this trend line. Basically now, again, we're at some sort of point where the trend line is in jeopardy. Clearly, we kind of got to overbought levels as well, similar to what we're seeing in the DAX. The region of support to look for probably comes at the 20-day moving average again, and then maybe the lower Bollinger Band around 20,325. On the S&P 500, you can see we also have the same sort of setup with the trend line, rising wedge pattern, potentially a second trend line forming here. At this point, all three of those trend lines have been broken. Even on the RSI, we had a rising wedge pattern forming, and that's also been broken. So we'll have to kind of keep an eye on this. Obviously, the 20-day moving average is your first level of support. Lower Bollinger Band comes at also a major level of support around 5870. So if we were to drop below 6,000, I think you could probably get to around 5850 to 5870 pretty quickly, because again, it looks like momentum is finally starting to break. But again, you didn't have this look in the NASDAQ, so to speak, not quite to that level. When you move over to the Dow, you also have a breaking of a rising wedge type of pattern, maybe what I call a parallelogram type pattern, which is essentially to me just a diamond pattern on its side. And here you can see the 20-day moving average right now acting as support. There is clearly a major level of support in this 43,000 area, with another area down here at the gap at 42,240. And again, we've seen the Dow really kind of top out here at 70 on the RSI. You clearly have a bearish divergence with the top here, with this top higher than this top and this top higher than this one, yet the RSIs haven't been able to go on to make two highs. They've just stalled out, just much like the FTSE 100 has done. So it's looking like, depending upon how rates and the dollar sort of respond to this inflation data here in the US over the next couple of days, that the equity markets could be in for a little bit of a consolidation phase, whether it be sideways or whether it be a further pullback. That we're going to have to just wait and see. But again, stronger dollar, higher rates, probably not the greatest environment for commodities, and probably not overall really the greatest environment for stocks either if there should be a meaningful move. Clearly, a couple basis points isn't going to be enough to do that. I hope you have a great rest of your week. Until next time. Bye.